Hey everyone. This week we are basically focusing on the basic ideas of finance. Uh, Within that, it comes down to really incomes and expenses in a nutshell. We're also going to touch a little bit in this video on assets and some classifications with them. Basically, when it comes down to your income sources, you have three primary components to those: income from your job, income from investments, and then income from lending procedures. Um, Within your job, you have to look at your wages if you're paid hourly or your salary. You know, if your salary, you really aren't eligible to receive overtime pay. However, if you're hourly, you can receive overtime pay benefits. In investment practices, you have profits from um, earnings on investment strategies as well as dividend payouts, whether they are capital gains, which is what you hope to have. You could experience capital losses as well. And then lending practices. And so, really, with this, you have to look at if you have a side strategy to your regular employment income stream. And so, what a lot of people do is they will have um, a side quote unquote hustle. And so, what I mean by this is, let's say you have your regular job and you work at that for 40 plus hours each week. A lot of individuals will have a side business, quote unquote, where they can earn additional income to free up more discretionary income, for more money to put into savings, to put into retirement, more money to invest. And so some of these examples, they could be a really great painter where they will paint for family and friends and sell those pieces. They might collect sports memorabilia where they might, sell some of that off. Um, they might have a rental unit where they purchase it and basically collect any kind of excess from that and put that into their own accounts. So, and we're going to touch base on that a little bit later in this video in regards to the asset side of things. Now, those are your income streams. Again, you have three main sources from income: your employment income, um, your investment income, and then any kind of subsidiary side business income. Expenses fall into two generalizable classifications: expenses from sunk or opportunity cost. And so, really, what it comes down to with opportunity cost is you have to sacrifice in order to receive something else. And so, when you partake in one opportunity or venture, or um, you choose to receive one form, you for uh, you give up the opportunity to receive the other. And so, myself as an avid golfer, my opportunity cost of purchasing a Scotty Cameron putter was foregoing purchasing a new TaylorMade driver. It's one or the other. And so, can't have both, can't have your cake and eat it too with opportunity cost. When you give something up, you pass on something, that's your opportunity cost. Um, when you take in one form, you give the other up. With sunk cost, it's gone, it's out of sight, it's out of mind. Once it's used up, it's gone. And so, um, it's money already spent, you can't get it back. Now, um, certainly there are other types of expenses that occur uh, more on a daily basis, which we classify under the recurring category. And these are things such as your mortgage payment, groceries, a car note. These things recur each month, unless you obviously have your mortgage is paid off, your car note's paid off. More than likely, though, these are recurring on a daily basis, on a monthly basis. Um, Shifting to the asset side of things. So, assets generally allow you to do one of two things. They either allow you to reduce your expenses or they allow you to increase your income. Now, when one of these occurs, the other has to be foregone, which means they do not occur simultaneously. So, some examples of these include paying your car note. So, when you pay your car note, this, in essence, when you pay it off, it reduces your monthly expenses, but it doesn't increase your income. For instance, if you have a truck note where you're paying $500 a month and you finally pay it off, well, let's say your last note was in June. So in July, you're freeing up $500. So you're freeing up $500 in expenses, but it's not necessarily increasing your income amount per se. Your mortgage note, same thing, falls into the same category. Savings account, it doesn't reduce your expenses, but it increases your income. You might choose to use that $500 to increase your income flow because you're increasing the amount of money you have saved up for a rainy day fund per se, but it doesn't reduce your monthly expenses. And then another example would be a rental unit. Rental unit where you might charge your tenants $1,000 a month, and you might take that in as extra income, but it doesn't necessarily reduce your expenses because unless you have it paid off out of your own pocket, where you've had this one unit, say, for 15 or 20 years, where all of the overhead is excluded, you still have expenses with that unit, such as if you cut the grass for your tenants, if you have maintenance repairs on it, if you have to fix up and paint the walls, if you have to buy a new ceiling fan, so forth and so on, things of that nature. So your expenses aren't excluded, but it does increase your income per se. So these are a little bit about the basic ideas of finance, which you'll encounter over the course of this week. Obviously, it's a little bit more in depth as you'll read the PowerPoints that you'll go through, things of that nature. But just on the surface level, they generally fall into incomes and expenses, and then you have your asset side of things. As always, if you guys encounter any issues or problems, or you need help navigating anything in greater depth during this week, please don't hesitate to reach out to me. Shoot me an email. I generally try to respond within 24 hours. Again, if you have any questions about anything, don't hesitate. Be glad to touch base with you all and provide a little bit more level of in-depth knowledge and in-depth understanding on the topic. Take care. Have a great week.